Hello there, I'm Marinade. This is Boom Bust, and these are the global financial stories impacting your world today. First up, Deutsche Bank was Europe's last investment bank standing before a recent shakeup of its business model forced the German bank to change its identity. I'm going to tell you all about that coming right up. Then Francis Coppola is on the show. I recently sat down with the associate editor of Pieria to talk about the Eurozone. Then in today's Big Deal, Edward Harris and I are discussing Greece's upcoming default. It all starts right now. Germany's largest bank is under pressure from investors to follow its rivals, like UBS and Credit Suisse, in scaling back on its unprofitable operations. In the wake of its $2.5 billion LIBOR rigging fine, Deutsche Bank will cut €200 billion in investment bank assets and pull back from a tenth of the countries in which it operates. They are doing this in an effort to reduce the risk and boost earnings for the company. The announcement came only days after Deutsche Bank reported a 50% drop in first quarter earnings. British and U.S. regulators fined the bank a record $2.5 billion for manipulating benchmark interest rates. Those fines certainly eroded gains in first quarter banking revenue. The German bank stuck with its costly universal banking model following the financial crisis. But now investors, they want to see Deutsche pull back from its more unprofitable operations. So far, Deutsche had been able to position itself as Europe's last investment bank standing, despite its cuts in certain business lines. But now, as part of a new overhaul, Deutsche will sell its Postbank retail division by the end of 2016 via a stock market offering and close up to 200 branches. That's more than a quarter of its retail network. This shakeup is expected to produce an annual cost savings of 3.5 billion euros. Meanwhile, the investment bank is pulling back on its dealings in swaps and repurchase agreements and redistributing up to 70 billion euro in trading areas such as emerging market debt and equities. Now, since the financial crisis, European investment banks have steadily lost market share to their United States rivals. In Q1, European banks accounted for 30% of global investment banking revenue. According to the New York Times, Deutsche Bank ranks 6th in the world when measured by investment banking revenue, while the top 5 investment banks are all based in the United States. Regulators around the world, but especially in the U.S., are demanding that all banks reduce risk. Deutsche Bank was particularly vulnerable because of its large exposure to businesses like derivatives contracts, which can be lucrative when things are good, but very toxic when things are bad. Bottom line, Deutsche's recent cuts seem to suggest that the bank had little options but to join other European rivals in scaling back. To get her insight on the Eurozone, Francis Coppola is back on the show. Francis is an associate editor at Pieria and runs the blog Coppola Comment. Now, we started off by talking about Angela Merkel, who some people call the de facto Queen of Europe. So I first asked Francis what she would do if she were the Queen of Europe, given the political constraints and the aversion to the Eurozone becoming a transfer union, in order to optimize the European Union. Now, I also asked her if her optimization strategy can be implemented before another economic crisis and political crisis overtakes these institutional changes. Take a look at her response.
I wish it could. I just don't see the political will. I really don't. I know I've said this before, that I feel that the movement towards harmonisation and federalisation is so painfully slow and so fiercely resisted that I fear that the whole thing could actually unwind long before it starts to come together. And in some respects, we have things pulling in opposite directions. We do have pressure towards federalisation and the creation of a full fiscal union. We do. You know, pressures are drawing the union together. At the same time as we've got pressures within the member states, nationalistic pressures, particularly in France, in Germany, in Spain, particularly in Greece, that are tending to pull the whole thing apart. So it's a question of which of those forces wins out. And I just have this awful feeling that it's the fragmenting ones that will win. sadly.
Now, Francis, there appears to be a banking crisis brewing in the heart of Europe. So can you tell our viewers what's going on with the bank that you call the Austrian Fannie Mae and why it matters?
Well, the real heart of the crisis is not the Austrian Fannie Mae. It was a bank that actually failed in 2008. Called Hypo Alpe Adria, it's a wonderful name, which is kind of a mortgage lending bank. That's what it was meant to be. But it had got itself into all sorts of hot water doing risky lending in southeastern Europe, in the Balkans, and doing pet projects for local politicians. It lost a lot of money. It got taken over by a German Landesbank in 2006. And then fairly spectacularly failed in 2008 and was eventually nationalised by the Austrian government, bought from the German Landesbank for, I think, €1 or something, in 2009. And there it's been ever since. They bought it and they stuck it on ice and did nothing with it. So last year they decided this really wasn't good enough and they had to resolve it. So they stripped out the bad assets and put them in a state-owned bad bank, a bit like Ireland's Nama. But that was called HETA. And then they tried to sell other bits of it, like the Balkan interests and so forth, and that didn't go too well either, but that was the theory. The trouble was the amount of capital that the Austrian government committed to the bad bank wasn't enough. So they did a review of all the assets and they've concluded it actually needs a considerable amount, like billions of euros more in capital than the Austrian government provided. And the Austrian government said, we're not going to do that. You have to wind it up. And they're winding it up under the new European Bank Resolution and Recovery Directive, which forces losses onto creditors. So what happens is that they've frozen debt service repayments from the bad bank, and they're basically going to impose losses on all that bank's, or as many as possible, of that bank's creditors.
Now, our understanding here is that the increase in Eurozone government debt and the Maastricht restrictions limit government's ability to deal with contingent liabilities from failing financial institutions like this Austrian bank that we've been talking about. So is that why we see principles to bail in bank creditors being enshrined into law?
Yeah, absolutely. This is all about saying that creditors must share in losses when things go wrong. If you think back to the 2008 financial crisis, Erin, you remember that, I mean, we bailed out banks all over the place. We rescued not only depositors, I mean, insured depositors, we even now are regarded as sacrosanct. But people whose deposits weren't insured, very big depositors, we bailed them out. We bailed out senior unsecured bondholders. We even bailed out subordinated debt holders. And in some cases, we even bailed out shareholders. We ended up with huge debt burdens for sovereign states, which are paid by their taxpayers, many of whom are considerably poorer than these creditors. And that's been a terrible burden that's caused, meant we've had to impose fiscal austerity and so forth to get these debts and deficits down. We don't want to repeat that. So what Europe is doing is saying, no, in future, if a bank fails, then its creditors must take a hit. And it will be in rank orders, so shareholders lose first, then subordinated debt holders, then senior unsecured debt holders, who would be senior unsecured bonds and large deposits, and then and only at the bottom of the pile, when there really isn't anything left, would we consider a taxpayer bailout of banks. And that's the way they're going in Europe, and it's going to have effects like making the cost of capital, the cost of borrowing for banks more expensive, because bonds will no longer be as safe as they were. Big deposits won't be as safe as they were, and so people will, the holders of them will demand higher interest rates.
Francis, are you at all concerned that we could still have another banking crisis in a big European country like in Italy or Germany? And if so, what would happen given the new bail-in principles that we first saw in Cyprus in 2013?
Yeah, it is a matter of some concern. There was an article in Handelsblatt which was looking at the size of the deposit insurance fund that's being created by across Europe to support deposit insurance, and concluded that it's nowhere near big enough to cope with the sort of systemic crisis that we saw in 2008. It's okay to handle individual failing banks as long as they're not too big, but in a systemic crisis it won't be enough to honour deposit insurance. So in Europe, deposit insurance operates up to 100,000 euros per person per institution. The fund is just nowhere near big enough. Now, against that, you have to put into place, you have to take into consideration the fact that the fund wouldn't be called upon until there would be other sources of funds, such as larger creditors and less secured creditors. So it's not quite as simple as that. But yes, there is a concern that despite everything, we may still find ourselves bailing out, I don't know, a UniCredit or something like that at some point in the future, and the fund won't be big enough to cover it.
It's time now for a very quick break, but stick around because when we return, Bianca Fascini will be on the show. Bianca is bringing us a roundup of the biggest financial stories impacting the global markets today. Then in today's Big Deal, Edward Harrison and I are discussing Greece's imminent default and how it'll play out. Plus, remember, as always, you can see all segments featured in today's show on YouTube at youtube.com/boombustrt and also on Hulu at hulu.com/boom-bust. Now, as we head to break, here are the closing numbers at the bell. Don't go anywhere.
The US and EU are joining to create the world's biggest free trade zone. It's supposed to boost economic growth and create jobs on both sides of the ocean.
If another country like the United States was able to compete for that market, prices would come down, consumers would be allowed to enjoy more poultry at lower prices.
But why then is it all so secret? Is this in the name of development or profiteering?
Same agenda that was tried in 1998. And in Europe, people said nein, no, non, I don't think so, niet, because nobody thought it was a good idea to give away all of the consumer and environmental standards for theoretical gains.
Do we speak your language? Want news, programs and documentaries in Arabic? It's all here on RT. Reporting from the world's hotspots, VIP interviews, intriguing stories. Are you here? Then try RT Arabic. To find out more, visit arabic.rt.com.
It is Liberation Day in Libya. The transitional government is declaring the country free.
You have won a revolution.
Your friends in Britain and in France will stand with you as you build your democracy.
Democracy, a new future for this country.
The great new Libya rising up.
New page for the Libyan people, the start of a process to establish democracy.
Libya is in for a period of horrendous chaos.
It's going to be an ineffective, powerless regime.
It's going to be a warring feuds, tribal feuds that is going to go on forever.
The deteriorating situation in Libya. It's difficult to see a path out of this chaos.
Libya is not managed anymore, not even governed anymore. It is experiencing chaos, and the question is, how is it that after an intervention, which took place more than 3 years ago, there has been no reflection on what should happen after?
In your city, in your streets, never back down like Tyrell, and the truth is what you seek. To analyze, investigate from the bottom to the top. You speak your mind like Sean Stone, whether they like it or not. I got Tabitha, Miss Wallace, with the wisdom and the pearl. Between the outrage and the evidence, what's going on in this world?
Watching the hawks, watching the hawks, watching the hawks. Listen when they talk.
welcome back. It's time now for a very quick news roundup with Bianca Fascini. Bianca, welcome. Now, I want to talk to you because I understand that Jeb Bush, who, by the way, has not even announced his candidacy for president yet, has raised tens of millions of dollars for this candidacy that hasn't been announced yet. So is this not true? What's the deal? Tell me more.
Yeah, exactly what you just said. He has not announced a run, but he has raised millions upon millions of dollars.
Good for him.
Yeah, thanks to super PACs. You know, we're just giving candidates the opportunity to raise endless amounts, and they haven't even officially announced a run for anything. So
unbelievable. Tell us more.
Yeah.
I think that you have a little story on this.
A little more info. Likely presidential candidate Jeb Bush told donors over the weekend he believes he's raised more money than any other candidate ever. Though he didn't include a specific number, unnamed sources told the New York Times the figure is around tens of millions of dollars collected in just 100 days. Unsurprisingly, the former Florida governor has mainly been raising money through his super PAC called Right to Rise. CoinDesk just released a look into Bitcoin's performance in the first quarter, showing an increase in wallets and investment. At the same time, the market value of all Bitcoin in circulation fell 36% from the fourth quarter of 2014 to the first quarter of 2015, while Coinbase puts it, Bitcoin struggled to gain mainstream consumer traction. U.S. services sector activity slowed in April, but this is understandable given that the March figure was the highest level since August. According to Market, its Purchasing Managers Index for the services sector slipped to 57.8 in April from a final reading of 59.2 in March. However, employment at the services company rose to a 10-month high. In a statement, their chief economist called it proof that the economy remains in good health. A British exit from the EU could cost the UK 300 billion euros, or 14% of GDP, according to a new German study. The Conservative Party has made a promise to hold a referendum on EU membership, which could occur depending on how the general elections go next week. The report claims that a Brexit would be a losing game for everyone in Europe and could do more harm to Germany than a Greek exit would. And Apple released their second quarter earnings, reporting $58 billion in revenue and $2.33 a share, beating analyst expectations of earnings of $2.15 a share and revenue of $56 billion. But we'll have to stay tuned to find out sales numbers of iPhones, iPads, and the recently released Apple Watch. Those are some of the major financial stories affecting your world today.
Thank you, Bianca. Are you going to get an Apple Watch?
No.
No.
I don't think so.
I don't think so either. Thank you so much.
You're welcome.
All righty. Where are we here? I guess over here now. There we are, camera 2. All right, so to get his insight into currencies and the oil markets, John Brynjolfsson is on the show. John is the CIO of Armored Wolf, and Boombus guest host Samira David recently sat down with John and first asked him what impact he thinks currency swings will have on U.S. multinational earning levels. Take a look at what he had to say to that.
I mean, it's pretty simple to understand that, a stronger dollar, weaker global currencies, most, the currency indexes suggest the U.S. dollar, like the U.S. dollar index is appreciated by 25%. Trade-weighted indices, which look more at the actual weights of currencies based on their trade flows with the U.S., haven't appreciated as much. In that case, the dollar is only appreciated by about 10%. But either way, what that means is that the foreign earnings of companies, in the companies that are owned by U.S. multinationals, the subsidiaries owned by U.S. multinationals, in the short term, any earnings they generate have shrunk by that 10% trade weighting or the 25% depreciation in the U.S. Or appreciation of the U.S. dollar index. That's the short-term effect. The longer-term effect is not as onerous because when the euro depreciates, as I alluded to earlier, that means the European companies are made more competitive. So those foreign subsidiaries of U.S. multinationals, although their last year's earnings are depreciated by the depreciation of those foreign currencies, their future earnings are, bolstered by the stimulus. So the currency markets in the short term will and have resulted in anemic earnings growth for U.S. multinationals. You know, in the longer term, it's not that onerous.
Okay, well, given that information, what sectors of the equity universe do you think offer the greatest value?
You know, we have an equity specialist portfolio manager. He's very bullish on airlines, for example. You know, the thought being that, especially for the large U.S. Carriers, the stronger dollar will encourage U.S. travelers to do more overseas travel, so that airlines are benefited in that way. Also, as we all know, the fuel prices have collapsed with the depreciation of crude from, you know, $90 or $100 per barrel down to, you know, as low as $44 last month, and now up to about $54, $55 a barrel. That feeds directly into the fuel costs for the airlines, so the airlines can profit from that. So you got a number of tailwinds for the airline industry. We're also involved in Revlon, which is a company that Ron Perlman has been managing and is a huge stakeholder in. In fact, he essentially controls 80% of the float of that company, and that's in play in terms of acquiring Max Factor and so forth. So there's some unique situations where highly leveraged small cap companies can profit from the current environment. And you know, it's more and more now a stock pickers market, which means that, you know, these global trends and the interest rates are impacting, you know, all companies positively and negative, and you really need to dig down into the details to find the diamonds in the rough, so to speak.
You spoke about traveling. That, of course, makes us all think about oil. So really quickly, I want to ask you, rig counts in the U.S. are down. We know that production output, of course, is up. At some point, these two have to come into alignment with one another. The question is when, and how do you see the oil market shaping up given this backdrop? We only have about a minute left.
Sure, yeah. I mean, the broad trend is in oil is a huge bear market. That bear market is quite obviously a function of both supply and demand. So on the supply side, we've had countries like Saudi Arabia and other international oil fields expanding production, you know, in Iran or Saudi Arabia or Venezuela, Mexico, Nigeria, any of these oil exporting nations, when the oil price drops, there is a lot of pressure on them to increase production, increase the number of barrels of oil. You know, that's their ideal scenario. At a minimum, they're going to maintain their existing levels of exports and production. So you have a global supply situation that's flat or increasing, even with the lower oil prices. Domestically, you have the shale producers, which have been growing production, you know, dramatically due to the huge investments in shale.
It's big deal time with the one, the only, the wonderful Mr. Edward Harrison. Did you like that introduction?
I did, yeah.
Okay, good. I'm just trying out new ones. You tell me what you like. We're talking about Greece's imminent default today. Imminent. I say that with conviction. Now, this is a particularly good topic today because later this week, on Wednesday, we'll be having an entire show dedicated to Yanis Varoufakis' next move. Excuse me, that will be Thursday. We'll also be hosting a Greece panel special. But, you know, today we want to focus on the next steps for Greece's upcoming default, so let's get to it. Now, this morning you posted on creditwritetowns.com that, quote, you anticipate either default in the hashing out of the reforms list during the extension or default when the new bailout agreement is under discussion. Now, this is kind of interesting to me. So can you break down these two options for us of how a default, an imminent default, would play out?
Yeah, and so, you know, actually they've now, those two scenarios have come to one. Yep. This was something that I wrote that I was reviewing from March. And basically what I was saying is that if you look at what the Greek government has been given in terms of a mandate, really there's not a whole lot of overlap in terms of the mandate that they have been given in terms of austerity versus what the Troika is trying to impose upon Greece. And therefore, as they hash out the reform list, there was a high probability, I said in March, that we would see a failure to come to an agreement, and therefore they would run out of liquidity, and then we would see a default. But what we saw in Riga over the weekend is that, in fact, they've completely eliminated the April deadline. The April deadline is now null and void. They're going all the way to the June deadline, which is when a new program is supposed to come into play. So at this point, we're in a situation where in the next 2 months, at some point in time, they're supposed to come up with a plan that meets both sides' objectives, and this is going to be the plan for going forward, for the foreseeable future. And I believe that that has a high likelihood of not happening, and therefore we could see a default in the next 2 months between now and June.
And I mean, you got it right with your post back in March, so I think that that's something to really kind of listen to what you're saying and know that there's a lot of validity to it. But, you think that the Greek government, that they might be able to function without using 3-month bonds, issuing those, and they can do this by using either a parallel currency or currency script IOUs in lieu of currency. This was really interesting to me. So I want to ask you, how would this work out? How would they use a parallel currency or currency IOUs? What does that even look like?
Yeah, interestingly enough, I was researching a little bit of this, and I saw that Steve Hanke wrote an interesting article in 2000 on Ecuador in terms of parallel currencies. Saying that they can work. And so, it'd be interesting to see whether or not that's something that would work in this particular situation. But basically, once they run out of money, the question becomes, do they have the legal authority to continue to issue short-term paper debt, which is now they can issue, and banks are buying in the open market. Only short-term, 3 months, 6 months, okay? So now the ECB could prevent them from doing that because of various EU rules that would contravene. And when that happens, the question then becomes, where are they going to get the money from? And one of the answers could be that they could actually, in order to deal with revenue, issue some sort of parallel currency, which is really a script or an IOU that says to the person that they issue to, look, we're not paying you with real euros, we're paying you with an IOU, but this IOU is payable in terms of taxes. You can pay your taxes with this, or if you transfer it to anyone, it's freely transferable in the exact same way that a euro would be. They can pay with their taxes with this. And so as a result, you would therefore be in the situation where you would be able to issue government money, so to speak, only on a localized basis and contravene the whole lack of liquidity that you're having.
You know what, this IOU sounds like a currency. To me, it's like an IOU for an IOU, kind of.
Right.
Yeah. We've talked about this a lot. Yeah.
You can make it a full-in parallel currency. I mean, if you call it the drachma instead of an IOU, and you started, printing pictures of Greek people on it and saying that, hey, wait a minute, these are exactly the same bills that we used to have 14 years ago, then you would have a full-on parallel currency. But in the, we're not going to be able to get there, overnight. At a minimum, you can get to the sort of like the script, the sort of what. I guess a friend of mine, Rob Parento, calls the tax anticipation notes.
There you go, tax anticipation. I like that. Thanks, Rob. That's a good one. Ed, I have a bunch more questions, but we have a ton of time to talk about this week. We're going to be focusing on Greece a lot, so we'll get to it then. Thank you so much, and thank you for watching. And don't forget to please tune in Thursday, April 30th for our very special Greek special, and we'll be talking about some of your questions on that show. So if you can please drop us a line on Facebook, we will look at them, read them, maybe talk about them right then and there. It's facebook.com/BoomBustRT, and also please tweet at us with questions, comments, concerns at Aaron Aid, at Edward NH. From all of us here at Boom Bust, thank you so much for watching, and we'll see you next time. Bye.